Hey everyone, Douglas here, Killer Market Analysis, and welcome to the weekly global macro update for Sunday, November 10th, 2019. It's 11:13 p.m. Eastern Standard Time as we get things underway for this week's update. And, I usually like to try and kick these things off with a brief kind of monologue to encapsulate where I think we're at. And I'm really at a loss for words other than to say that things are really playing out very much as expected. I wish I had kind of something more intriguing to say or sophisticated to say, but it really just boils down to this market is playing out as I expected. Over the last couple of weeks, we've seen a big takeoff in equities. That's very much been in line with what my expectations have been. I've thought that's going to be the best trade into the end of the year. It's certainly turning out to be the case. Bonds are rolling over as expected. We're starting to see those push lower. Dollar even making a bit of a recovery after that sell-off. So yeah, I just don't know anything more to add. So at this point, as things are starting to really play out, as we thought, and it's obviously not a bad thing. It just creates for dull updates. But I am at that point where I'm starting to see a few things in Shin that are starting to worry me. A couple things that I want to be keeping a very close eye on, because I think we're going to see a takeoff here as we're already seeing, and I think we're going to start to see that momentum build upwards, and that is going to start to introduce some risks into the market. And that's really, I think, where we're at now, is we want to start looking for those risks and anticipating what could bring an end to this rally. So with that being said, I do have the macro triangle up on the page here, and the only change from last week, you'll notice, and this will kind of tip the hand for the upcoming risks, is the sentiment, momentum, and volatility. I brought down one notch to just bullish neutral, just to kind of indicate that I'm starting to see the first signs build up that on all three of those, sentiment, momentum, and volatility, that in the weeks, more likely months ahead, we might see some issue there. Now, remember this macro triangle, I rate these based on kind of the overall importance that the overall significance or the weight that they have relative to kind of the entire economy, to the entire equity space. Fiscal flows, absolutely most important. Those are the bedrock. As long as those remain in kind of a bullish, increasing nature, overall kind of deep recessionary risks will remain relatively low, and any sell-off should be bought not too much after. I'm thinking even like in late 2017, 2018, and then again 2018, 2019, and both those sell-offs, the fiscal flows remain pretty strong, and we were pretty confident that we would bounce off after both those sell-offs. Banking flows, slightly faster moving than fiscal flows, still very important, but not quite as important, not quite as significant to the overall economy. That's why we have that as the next step up in terms of impact. Still, though, remaining very bullish, and I think at least for the weeks, months coming ahead, we should see continued push higher in those flows. We'll look at that, and then we build on top of that interest rates. If interest rates get too high, that can play a role into a lot of kind of fund waiting and that sort of thing. So you'll see a lot of funds move positions out of equity positions into fixed income. And there's a lot of kind of automatic built-in trading that occurs, and then on top of that, interest rates also get built into different risk models. So even though we've been seeing them start to creep back up a little bit, we're still in a very low kind of bullish environment with interest rates for the time being. And at least as the Fed has come out and said, I think we can at the very least expect interest rates to remain where they're at. I think the actual 10-year and 30-year will continue. Those rates will continue to push higher. Likewise, bonds will then push lower. But at least in terms of where the Fed is setting the rate at and kind of where they're signaling the target will be into the future, I think will remain relatively flat, at least into those first few months of the new year. So again, that remains in a very bullish state. But it's the sentiment, momentum, volatility that I think are going to begin to present the biggest risk in the most immediate future that we would see that, which again I think would likely be into the new year. And then just to kind of wrap up my conversation on this right here, I'm going to also say that the rest of the world and the news, I'm just going to keep it neutral. I think those are the shortest term risks, maybe less so rest of the world. You might be able to kind of tie that in with sentiment, momentum, volatility. Again, I don't think those two things in particular in and of themselves could cause a recession in the US or kind of a 2008 or 2000 scenario, but they are, at least on the short term, risks that can be priced into markets. And then obviously the news, the shortest of them all, but for whatever reason, well, not for whatever reason, for the Twitter in chief reason, the news has played a bigger role in terms of just kind of sparking sell-offs in terms of risk. And I think that is still there until really the trade war thing gets settled and that goes away. But rest of the world in news, we're not going to really talk too much about those tonight, but I still have those as neutral risks. Right now, they're not really bullish, but they're not really bearish either at this point in time in terms of overall pricing. And if anything, too, the rest of the world is actually starting to tick up a little bit. We might be able to switch this to bullish neutral soon. However, there's a huge debt overload or overhang with the rest of the world, and that is just, I think I've expressed this in the past, I just never see the rest of the world ever going above neutral. Any sort of rally you're going to see, I think, will always be short-lived, just because of the dynamics of the global economy right now. But that's where we're at with the macro triangle. Again, we'll get into the risks I'm seeing in just a second. But in the meantime, what I want to switch to real quick is just a quick update on where we're at the fiscal flows and how November is setting up. And we're already setting up quite strong. We had our largest average day. So again, I take the last 365 average, average that out, and last year's average that out to get on average, how many new dollars are being put into the economy from those flows from the Treasury. And we hit an average high of 20 billion 400 million on November 1st. Which on the day itself had like 940 billion new dollars enter in. So we had a big upswing there on fiscal flows. And the day of, that can always create a bit of a risk. Obviously, that was a Friday. We had a lot of good news that mitigated that risk. But those fiscal flows, you get extremes whenever you get on the extreme of either side, either massive reserve builds on one end or reserve drawdowns on the other. Those can cause a bit of risk on both ends. And I have noticed another pattern. I'll talk about this in a future video, but I've been noticing kind of patterns build up a little bit more on these kind of reserve, we'll call them reserve pops and reserve drops, particularly in the bond market as well. You see this apparent where you get kind of a build up into those big fiscal days, which usually are the first of the month. And if kind of stars align, first of the month, you can sometimes get like a Wednesday the 15th. There's reasons for this, but if there's a Wednesday the 15th, you can sometimes see a big move in bonds, and that can put a little bit of pressure. So I thought that might be the case. Obviously, the news came out on Wednesday or on Friday the 1st that kind of mitigated that risk. But notwithstanding, we have now, those reserves have now had a chance to enter, and we've obviously seen a continued rally after those big days have occurred. And the reserve support, or the fiscal flow support just is, it's super strong right now. Obviously, we're only a reporting weekend with a huge day to kick things off for November, but we're going to expect in November to be larger than October. We're going to continue to see this theme move forward until some big policy shift, but it's still worth looking at. This is kind of the bedrock of really kind of what MMT teaches and the bedrock of the analysis that I do. So we will continue to look at it just in case anything ever gets thrown off and those days that kind of come in that might disrupt short-term ripples and stuff. But everything's looking really good. I'm going to, like I said, expect a larger November than October and a larger probably December than November moving forward. And that just really sets up well for the markets to digest that money and a lot of that money end up in equities, since we still are, based on that macro triangle, based on where we're at, with interest rates, with where volatility is at, with where momentum's at, markets still look underpriced. So there is, there's still a lot of reason to believe that this money is going to shift into equities moving forward. So that's where we're at right now. Things continue to be right on course, and kind of not skipping a beat there. Moving back, let's look at bank flows, and total bank assets did take a brief dip year over year over the past week during the last print. I'm not exactly sure what to make of that, because what we're going to see is both on other securities, risk assets. We saw them pop just a tiny little bit to finish off or to this week. So no big real drawdown. And in fact, we're starting to see the round there a bit on the chart. Let me switch over to foreign assets as well, kicking back up a little bit. The past few weeks we had been trailing down, but still the overall path here seems to be rolling upwards. No real worry there. Moving over to treasuries. We did see a bit of a pop in treasuries. So again, on the banks itself, in terms of the overall position, even though treasuries continue to push a little bit lower, to finish off last week, but no real worry here. I still think this will likely begin to trend downward. And again, the big thought here is as treasuries begin to, in terms of what the banks are putting on the books, begin to roll downwards, or at least that momentum begins to wane, that is kind of the green light for us to know that equities are getting or at least risk assets, and some of that would be equities, are getting the go ahead in terms of fund managers and that sort of thing to go ahead and hit the buy, and we're seeing that play out. So that's the dynamic there that we're seeing. Long story short, sum it all up, bank flows, fiscal flows looking very strong right now. No real risks or worries here, which makes me think, at least for the coming weeks, months, into the end of the year, we should be pretty darn good. But this does bring me to the point where I want to start talking about the risks. And a little over a year ago, I can't believe it's been that long, but a little over the year ago, I made this video on the YouTube side of things that just talked about volatility, risk parity, that whole complex, and why volatility can spark major sell-offs. And I really think with some of the headlines I'm seeing and some of the data that I'm seeing, that this will likely be the big risk. So what I'm going to do is I'm going to link to this video in the comment or in the descriptions, the Patreon page. If you want to watch it in more detail, please feel free to go ahead and do that. The big idea here is pretty much that it just shows how the mechanics of, if you're not familiar with risk parity, or just generally how volatility gets priced into the markets, it's a good explanation, a good demonstration of how that happens, and how a spike in volatility can kind of feed on itself. And I go into the details there. So I really think that's kind of one of the big worries. As volatility gets crushed lower and lower, that makes equities look more and more enticing or less risky when they're really not. And when that whole thing unravels and volatility starts to spike up, that pushes equity prices back down, which then makes you recalculate the risk on the equities, which then makes you sell them, which spikes the volatility. You guys get the drift. The entire thing kind of unravels. And that's essentially what happened in 87, as I explained in the video, and I think to a certain extent that's what happened at the end of 2018 as well. We saw a lot of that unraveling, and I think this sort of risk is going to present itself. And here's kind of my reasoning why. First thing first, if I look at the VIX, I'm on the daily chart here. Let's actually just kind of pay attention to what occurred from 2015 and that huge spike all the way down into 2017. We saw higher lows kind of continually put in the VIX until we finally broke this kind of wedge pattern down and really started to make some new lows. And then from 2017 through 2018, we had very tight range in the VIX, never getting above 18 for that entire year and a half time frame, until we finally exploded up, obviously, into 2018. And as it is, we're starting to break down from that higher low trend over the last 2 years here in the VIX once again, and playing out a very similar wedge pattern. I'm not trying to say that, since this happened in the past, we're going to get a fractal play out here and it's going to look the same. I'm just pointing out that we are starting to get a more condensed, tighter, range-bound VIX, and what I'd be very curious to see over the next however long it takes to play out, if we get like we did during 2017 into 2018, if we get a very compressed VIX one more time. If that ends up being the case, then that create the environment necessary for even the smallest moves down in equities and up and volatility to really ignite the flame and kind of get the ball rolling. So I think this starts to present a big risk as the volatility pushes lower. Saw some headlines as well since we're on the topic. Just noting that record short VIX positioning reflects fear elsewhere. Just an interesting headline that's just showing that we're seeing near record short VIX positioning. It kind of corrects the the more clickbait headline further down in the article. If you look at the commitment of traders, total reportable short positions, we're starting to see a build here as well. I mean, these things can last for a long time at elevated levels. So again, I want to use other tools along with this just to point this out. But the fact of the matter is, if we're going to get a sell-off greater than say 10, 20% like we did last year, it's going to come from this risk right here. It's going to come from volatility pushing too low for too long and sentiment getting too high for too long, and that's really kind of tying this back to the bigger picture. That's really why I'm spending time on this. Is that this is what could cause not a recessionary sell-off to occur, but a big enough sell-off where not only might we not want to get out of the, or not only would we want to get out of the way, but we might also want to short it and take advantage of it on the way down as well, depending on if the timing is right, how pronounced it looks to potentially be. So bear that in mind. Watch that video if you're interested in more details as well in terms of kind of the play there and how the mechanics work of risk parity and whatnot. So you can check that out. Some other things to look at. I guess I'm doing this in the backwards order from what's above me. Let's look at sentiment real quick, and we're starting to push a little bit higher here. No extreme by any measure, but definitely getting closer to that kind of 45 range that seems to trigger some sell-offs on the short run. I don't think, I think we're in a pretty good spot where we can get a rally and kind of get this thing building up, similar to what we did back in late 2017. But it's worth noting that for the first time in a while, we're getting some slightly above average activity here in the bullish sentiment, and likewise bearish sentiment. We're starting to push low here. So yeah, just keep an eye on these. I mean, I think obviously if we get next week or the week after, I think maybe the week after might be a little bit more likely of a sell-off, and I think maybe even at the end of November we could see a couple days, really December, that could trigger a little bit of a bearish read here that could kind of reset this. But I do think the trend overall in bearish momentum or bearish sentiment is going to be lower, and bullish sentiment is going to be higher, where we get again a couple weeks, couple months of a build here for momentum to kind of start to get higher and higher and get to those extremes where we really need to pay attention. So bear that in mind as well. Let's see. One other thing too in the very short run that I'm going to be paying attention to is the daily RSI and even the 4-hour RSI to a lesser extent. But I want to see kind of how high we build up. We really haven't got above overbought for more than a couple days in quite a long time, and they've been very short-lived moves when we did get overbought. And I set my overbought at 70, and the last time we really rallied into overbought territory was again into the end of 2017. So we'll see what happens as we approach overbought in the daily. And I think one thing that really could end up playing out here is kind of a pattern where we rally, get like a day or two where we sell off maybe 3, 4, 5%, and then just continue on. And I'm thinking a pattern, just to kind of show you what I think could happen. I'm thinking a pattern kind of similar to what occurred. I don't know what triggered this, but it's just a pattern that popped in my mind that I saw recently that occurred in Apple here a couple months ago in August, and it makes me wonder if there was like a bad news event or some bad earnings report. Either way, I could see something like this where we get a sell-off and then just very quickly, within less than a month's time, rally back up to new highs, probably even less than a couple weeks' time, rally back up into new highs just due to the sheer kind of overboughtness and just the rally that we're in right now, momentum-wise. But yeah, it's something I'd be keeping an eye on. Again, it's nothing I'm going to get out of the way of at this point. because it could just never materialize. But we're seeing one heck of a rally here, and when we do get into overbought territory, we need to start paying attention to those risks as well. It's when you get into huge extremes, close to 90, like we did back in January, that we want to be very careful of. Anything above 85, really probably anything above 80 should definitely be making us think that the risk reward there begins to diminish. So yeah, just another thing to keep on your radar in that entire kind of momentum, sentiment, volatility quadrant of our macro triangle. But as it stands, I still think we're bullish neutral, and I don't want to oversell this. I really think for the next couple weeks, couple months, we are just going to be rallying higher from here, with all market conditions remaining equal. I'm sure any tweet could send us down for a day or two. I'm not saying we're going to have, 0.5% rally every single day from here on out. There will be risks along the way, kind of short-term consolidations and that sort of thing. But I don't want to I don't want to oversell the move down to bullish neutral. I almost left it at bullish. But I do want to start to keep an eye on the reality that will likely be facing us in the not too distant future, which is just going to be a huge move in sentiment to the bullish side and a huge push down in volatility as well that could really spark some things going forward. So that's what I'm going to keep an eye on. But other than that, things are just looking really, really strong overall in equities, and there's a reason that I've been very long equities, and there's a reason I've been very bullish, and it's finally playing out. So that's kind of where we're at. I'm going to show you the portfolio real quick. I did make a trade and I completely forgot it. It was at the end of the day, I think on Wednesday, and it kind of skipped my mind to post it. Really nothing all that big in terms of difference. I just rebalanced and sold a little of the XPL to buy TQQQ. I'm probably way overexposed here than what I probably should be, but my confidence level is pretty high right now, and I'll probably take it down a notch or two later this week, or maybe near the end of the month as we approach the end of November. I just thought it was worth the risk, and so far it has been. So still have that short dollar position. It's barely counterbalancing anything right now, and then a little bit of cash. So maybe I should expand the dollar short position, or take a little off in the not too distant future. But either way, I'm still super bullish, and not too worried in the time being. Speaking about positioning, I guess another thing too, that one of the reasons why particularly kind of those VIX vol moments worry me is because I do play leveraged ETFs. If you're not playing a leveraged game, or you also maybe have a long short book or something like that on the side, or you're doing also individual stock picks and that sort of thing, I'd be a little bit less worried about the volatility moves. But being that I play leveraged ETFs, those can obviously take one heck of a beating. So I pay a little bit more attention to that, just to kind of get you into my psyche as well, in terms of, why I might find some things more important than others. But there's a portfolio, obviously very long here. And like I said, probably closer to the end of the month, I'll be looking to take the profits and see where I can run. I wouldn't get out entirely, but my exposure certainly needs to come down a little bit and get a little bit more hedge there overall. So yeah, that's where I'm at right now, and I should really just express kind of my conviction in terms of where we're at with equities as a whole. I did post a couple weeks ago that I dropped the bond short. And I do think bonds could continue to push lower. I guess just the way I'm thinking about it, and not, it wouldn't, I guess it wouldn't be wrong one way or another, is I think bonds are going to continue to push short or push lower, but I think equities just provide the better kind of risk reward overall right now. So that's just why I'm kind of constructed the way that I am. So yeah, that's where I'm at right now in terms of the portfolio. I'll probably, when I do finally start to unload some of the stock positions, depending on where we're at, depending on kind of what the data looks like, I'll probably get into more of a traditional kind of long stock, short bond mix. Long stock, long bond mix, as we get maybe a little bit starting to inch a little bit closer, assuming bonds really reprice to the lower side. A couple other things too. I guess I could probably pop these charts up real quick as well. I'm just, gold is really taking a hit right now. Give me 1 second to pop these up. Gold is really taking a hit. Finally selling off, and we're still not necessarily out of the realm of the possibility this thing could rally, but I'm still completely just unimpressed with anything gold is showing me here, and so I think it's been smart to stay out of this, out of gold's way. I don't think it's a good short here either. If you wanted to really be short gold, I think there are better ways to do it than risk kind of a counter trend move. So yeah, there's that, and same with oil. Although although I think gold is going to go lower, I just don't think it's kind of worth it. Same thing with oil here. I still think we're likely going to push higher. It's just kind of how higher, and what's the downside risk as well. So it's been pretty good to stay out of those ways. I know a few of you have emailed me. You guys are a little bit more closely in tune with the energy sector, and by all means, don't let me hold you back. But hopefully you can kind of take my analysis and mend that, or put that with your other thoughts, and build upon that. So yeah, that's where I'm at across the board in terms of my portfolio and positioning. I still just think equities are the place to be, and I really think a big rally is definitely underway. We're gonna have some risks in the not too distant future, but it wouldn't surprise me to see a very strong rally coming out of this 2 years long consolidation pattern here. Anyway, that will wrap things up for this update this evening. So yeah, things are really flying high, going well, and very excited into the end of this year to hopefully eke out some not eke out, but really just really get some more profits and finish the year off strong. So that's it for this update, and good trading for this upcoming week, and we'll see you next time. Bye bye.